Hello guys, welcome back to our YouTube channel, Keleza Lestabza Tabisoranti. So guys, in today we are going to do general journal. We are going to take a look at general journal, meaning we always apply our steps every time. And then it says activity 5. It says record the following transaction in our general journal of Khatebe traders, meaning we are going to do a general journal, and then we have our answer sheet. And then guys, let's take a look. First step, as always, we look from our extract of the pre-adjustment trial balance, and then it's step number 1. And then we have all the accounts that are given to us, provided by given to us, such as fixed deposit, debtors control, drawings, rent, advertisement, bad debts, water and electricity, as well as our fixed deposit. And then guys, step number 2, it's our adjustments. Step number 2 is our adjustment. It's step number 2. And then let's take a look at the first our trial balance. Our trial balance on the 28th of February, meaning the 28th of February. And then we must always have our timeline. And then we are going to draw our timeline. And then in our trial timeline we have the financial year end month, which is February, and then it started when March. Then it's March, April, May, June, July, August, September, October, November, December, as well as January. It's 12 months period. In accounting, we stick within the 12 months period, ending when 2021, started when 2020. And then guys, step number 2, the account of P Boroko, a debtor, has to be written off as a bad debt. So now guys, we are writing off the account of a debtor, which is bad debt. And then guys, what you will do is that you need to have your small ledger accounts, and then 2 of them. And then we are writing off a debt, and then we are going to have debtors control. And then debtors control, it's regarded as an asset, meaning it will increase under your debit side and decrease under your credit side. So whenever we are writing it off, the debtor is irrecoverable, meaning he's no longer going to pay us. He is nowhere to be found, meaning now our assets need to decrease, meaning they will decrease under our credit side. So one account is is credited as a bad debt, and then now we need to open an account for bad debts. And then bad debts, it's owner's equity. It's an expense account. Then all expense will increase under debit side, while they decrease under credit side. One account it's credited, meaning another account must be debited. And then bad debts will be debited, meaning our expenses will increase. So now let's record this to our general journal. And then our general journal, as I have told you, that you always start with the debited account. And then which one is our debited account here? We find that our debited account is it's debtors, it's bad debt. It's credited with how much? 180 rand. And then we are going to write account debited first. It's it's bad debts, with how much? With 180 rand. And then the account that is credited is it's our debtors control. And then we are going to write debtors control, and then is the account that is what it's credited. And then what is the narration? What is the reason? Why are we saying so? Then we need to what? To write the reason. And then we'll say what? Debtor irrecoverable. Recoverable. The debtor is what? Is irrecoverable. So the debtor cannot be what? Cannot be found. And then we go to our transaction number 2. And then guys, make sure that you understand and you become calm, and then you understand the double entry principle. In this case, double entry principle is the one that is working a lot, guys. And as we know that the debtor now cannot be traced, meaning debtor's control account will be affected, meaning it will decline while expenses are following, and then we record the bad debts. And then so now let's take a look at transaction number 2. It says included, meaning there's something inside there, included in the total amount of advertising. So now we know we are talking about advertising. Included in the total amount for advertising is 4,600 for a 5-month contract, which expires on the what? On the 31 May 2021. So now guys, let's go back to our timeline and see. So now we are given how much? We are given 4,600, and this 4,600 was paid for a 5-month contract, and that 5-month contract will expire when? On the what? On the 31 May 2021. So guys, and let's go to our timeline and see the 5-month period, meaning it says it ends when? May on the 30 May 2021. Then our financial year, guys, ends when? February 2021, meaning now we need to what? To extend our financial year. So how are we going to say it? It's going to say we're going to have February, March, April, May, and then May, on the May 31 May 2021, the contract is doing what? It's expiring. And then guys, in accounting, we only work within our financial year, meaning that anything beyond our financial year, then it must be subtracted, meaning it's what? If ever it's an expense, then it's going to be let me change a pen for you guys. If ever it's an expense, then it will be what? It's a what? It's a prepaid expense, meaning we paid upfront, we paid ahead. Then we in accounting, we only what? Stick with our 12 months period, our financial year. Anything beyond our financial year then needs to be subtracted. If ever we got an income in advance, then it will be what? It will be going to be what? Income in advance, received income in advance. So now in this case, we only what? We paid in advance, then it's what? It's prepaid expense, then it must be subtracted. And then how much are we going to subtract? And then guys, we are going to say the money that we got, which is how much? 4,600. The amount that we paid, it was 4,600, and we paid for the period of 5 months. So each and every month we were supposed to pay how much? So each and every month we were supposed to pay 920. Then we were supposed to pay 920 each and every month. And since we are sticking with our financial since we are sticking within our financial period, then the rest of the months after our financial period, we don't want them. So how many months we need to take out from the money that we received? So we need to take how many months? 1, 2, 3, meaning we don't need 3 months. Then 920 per month multiply by 3 months, and then how much is the total that needs to be subtracted? It's 920 multiplied by 3, and then we need to what? To subtract 2000. We need to subtract 2760, and then this 2760, it's what? It's prepaid expense. And then now we can draw our small ledger account, and then we'll say we have what? Advertising. We have advertising, and then it's an owner's equity, an expense account, meaning all expenses will increase under debit side while decrease under credit side. So from the advertising, we need to take out money. As we said, it must be subtracted. All the prepaid expenses, all the money that we paid ahead after our financial year, they need to be subtracted. And then based on our ledger account, we see there is positive sign under debit side, there is a negative side under the credit side, meaning we are going to record under what? The credit side. Then the negative side, which is the credit side, then it's going to be how much? 2760. And then now, guys, in one account, it's what? It's one account is credited while another account must be debited. And then which account will be debited? It's what? It's prepaid expense. So now we need to show that there is a what? There is a prepaid expense, and prepaid expense, it's an what? It's an asset, meaning that money is going to come back to the business and then we'll pay it in the next financial year. And then all assets will increase under the debit side while they decrease under what? Your credit side. One account credited, meaning another account must be what? Must be debited. And then, guys, we can record this information in our what? In our answer book. And then it's number 2, and then we are going to say the first account debited, it's what? It's prepaid expense. And then we are going to record let me change a pen quickly, and then we are going to what? To record. And then it's what? It's prepaid expense of how much? Of 2760. And then which account is credited? It's advertisement. That money needs to what? It's no longer an expense, it must come back to us. So all our expenses, they will decrease for that financial year. And then we are going to record it, and then it's what? Advertising with how much? 2760. And then what is the reason for that? And then we'll say what? We'll say the reason is that the money, it's what? It's paid in advance. The money is paid in what? In advance. And then, guys, let's take a look at our transaction number 3. So, guys, what you need to know is that you must always work with your timeline. You must use your timeline, and then if ever you have your timeline, then you will be able to understand the transaction and work around those given transactions. And then, guys, let's take a look at our transaction number 3. It says that water and electricity owed, meaning we are owing water and electricity. Water and electricity owed for February 1,200. So guys, now again we are coming for our what? To our financial year. So this is our financial year. It ends when? February 2021, meaning it started when? March 2020. Then it March, April, May, June, July, August, September, October, November, December, January. 12 months period, meaning we need to stick within the 12 months period rule. And then guys, so now based on our transaction, it says that we are owing water and electricity for the what? For the month February. We are owing water and electricity for 1,200. And then guys, in which month? The month February, meaning we are within our 12 months period, meaning there's a shortage. Meaning if ever there's a shortage, we are owing something or we are expecting something and it has not yet been received or paid within the financial year, then it must be illustrated by a positive sign. And then let's go back to our second transaction. We spoke about prepaid expense. Prepaid expense, they are what? Beyond our financial year, and then we subtract them. But as anything that is less than or within our financial year, then it will be what? Showed by a positive sign. And those things, they are called what? Accrued. They are called what? Accrued. And then it will be what? Accrued income or accrued what? Expense. So we'll have accrued income or accrued expense. Accrued income, you will get them, maybe it's rent was not received, and then it will be an accrued income because of it's still not yet been received. And then in this case, we are what? Talking about expenses. Water and electricity, it's an expense. Then it will be what? Accrued expense, and then it must be shown by a positive sign, meaning whenever we complete financial statement, then we are going to add 1,200. And then guys, so now since we know we have a water and electricity and it's an accrued expense, then we need to open our ledger account so that we can record to our general journal. And then guys, let's open our ledger account for water and electricity, and then we are going to have our ledger T account, which is what? Water and electricity. Water and electricity, its owner's equity expense account. And then meaning all expenses will increase under your debit side while they decrease under your what? Your credit side. And then water and electricity, as we said, it needs to be what? It needs to be added. And then we are going to look for positive sign, and then we find out that the positive sign is under your what? Your debit side. And then we are going to what? To record the the amount, which is how much? 1,200. One account credited, meaning another account must be debited, and then we need to show that account that will be what? Credited. Then the account that is credited, since we are talking about the accrued expenses, then it's going to be an accrued expense, and then it's going to be what? Accrued expense. And then accrued expense, it's a what? It's a liability to us because we need to pay. Then it will be what? Positive under credit side and the negative under the what? Your debit side. And then one account credited, meaning another account must be what? One account debited, meaning another account must be what? Credited. And then we are crediting. And then water and electricity under accrued expenses will be what credited as 1,200. And then now we record this information to our general journal. And then the first account that we need to start with is what? It's water and electricity. And then we are going to write let me change the color pen. And then we are going to write water and electricity, and then it will be debited with how much? 1,200. And then the account credited, it will be what? The accrued expense with how much? 1,200. And then guys, what is the narration for that? What is the reason for that? And then the reason for that is that water and electricity is still owable. What? Still owed. And get it guys, is still what? Owed. As they told us, water and electricity is what? Is still owed. So we still owing. That's why we are showing them in our general journal as follows. And then guys, let's go to transaction number 4. So guys, as I have told you guys, timeline is the best thing to use, and make sure that you understand that in accounting we stick within our financial year, which is 12 months period. Anything beyond our 12 months period, anything above our financial year, then it must be subtracted, and those things are what? Are prepaid expenses and then income received in advance. And then anything that is less than our financial year or in between our financial year and is still owable, or it needs to be received, then it's they're regarded as accrued. It will be what? Accrued expense and then accrued income. So guys, let's take a look at transaction number 4. Transaction number 4. And then transaction number 4, it says the fixed deposit account appears in the books as follows. The fixed deposit account appears in the what? In the books as follows. And then whenever we go to our pre-adjustment trial balance, we find that we have a fixed deposit of 105,000. Then we have a what? A fixed deposit of 105,000, meaning there we go, a fixed deposit of how much? 105,000. And then they are telling us that fixed deposit appears in the books as follows. And then on the 1st of March, and then we find out that on the 1st of March we have balance brought down of 60,000, meaning they at the beginning of March we had how much? We invested 60,000. And then during the financial year, and then guys, let's just show our timeline. This is what we have. And then financial year ends at February, it started March, April, May, June, July, August, September, October, November, December, January, 12 months period. And then during March we had how much? We invested 60,000. And then along the way, July again, during July again we invested how much? 45,000. We invested 45,000. So now we understand what is going on with this information, and then we move on. Point: both amounts were invested at what? At 15%, meaning they give us a rate of how much? 15% for both of the what? Of the amount. And then they say calculate interest for the accounting period. So now guys, we need to calculate the interest at the what? At the accounting period. So now we are going for both amount, as they told us, for what? For both amount. And then now we know again we have how much? 45,000. So now we know that 45,000 plus 60,000 plus 45,000, then it's how much? It's 105,000, which is what? Which is this amount of fixed deposit at the beginning of our financial year, but it was invested in different months. The first 60 it was March, and then the 45 was July, and then we can continue. So now we need to calculate the interest for what? For these two amounts. So how much are we expecting to get at the end of the financial year, and then multiply by how much? 15%. Now we are applying our percentage, and then multiply by the months. How many months the interest are we expecting interest for? How many months? Then from March, that 60 we invested March, then it will be 1 2 3 4 5 6 7 8 9 10 11 12, meaning we are expecting for how many months? For 12 months, and then equals to, it's 12 divided by 12. And then for 60,000 we are expecting to earn an interest that is, and then we are going to say 60,000 multiplied by 15 divided by 100 multiplied by 12 divided by 12, and then we are expecting to get how much? 9,000 for the 60,000 investment. And then we move on for to another amount, which is the 45 that was made during which month? The 1st of July. And then we are going to say multiply by 45,000 multiply by 15 divided by 100 multiply by how many months? This money we are expecting an interest for how many months? From for investing with 45,000. Then it's going to count from what? From July, because of we made an investment when we made an investment during the what? The 1st of July, meaning we are going to start counting from July. But if ever it was the 31st, meaning if this was the 31st of July, then we were going to start counting from when? From August. But now because of the 1st, then we are starting with the month of July. Then we are expecting to end for which month? For July. We are going to say 1 2 3 4 5 6 7 8, meaning we're expecting to earn interest for how many months? For 8 months. Then it's going to be 8 divided by 12, and then equals to how much? And then it's 45,000 multiplied by 15 divided by 100 multiplied by 8 divided by 12. Then we are expecting to earn interest of 4,500. And then at the end of the financial year we are expecting to get how much interest? Then we are going to say 9,000 as our first interest plus 4,500, meaning at the end of our of our financial year, which is February, we need to earn 13,500. We need to earn 13,500. This is the money that we need to get at the end of the financial year. So let's go back to our pre-adjustment trial balance and see how much we have. We find out that we have only 9,000. So guys, in this case, meaning what is happening is that we only have what? 9,000, meaning under what? Interest income, or interest on what? Fixed deposit. We found that it's an income account, it's an owner's equity. We find out that we only have what? We only have 9,000, meaning there's a shortage there, and that shortage is how much. It's we are expecting to get 3,500. Just to find out, we only have 9,000, and then the shortage is how much? 4,500. Then we need to do what, guys? We need to add that thing. It's called what? It's accrued income, meaning there was a shortage. There's a shortage of money there, and we need that money for 45,000. It's how much? 4,500. Then we need to what? To have that money, we need to tell them that we need to have how much? 4,500. They must add 4,500, and that thing is what? It's an accrued income. It's an accrued income. And then at the end of our financial year, we'll have how much? 13,500. We'll have how much? 13,500. We'll have 13,500, and then it will be our profit or loss, 13,500. And then since one account is credited, which is what? Accrued income, then we need to also open the what? The accrued income. We also need to what? To open the what? The accrued. We also need to open the accrued income. We also need to open the accrued income, and then it's what? Accrued income. Accrued income, it's what? It's an asset. Increases under your debit side, decreases under your what? Your credit side. And then one account credited, meaning another account must be what? Must be debited. 4,500 for what? Interest on what? On fixed deposit. And then, guys, now we can do what? We can record this information in our general journal. And then we come to our general journal, and then we record number 4, account that is debited. It's what? It's accrued income, with how much? 4,500. And then the account that is credited, it's what? It's interest in fixed deposit. And then we have what? Interest on fixed deposit, credited with 4,500. And then what is the reason for that? And then it's still what? Receivable. It must be receivable. Still what? Still receivable. And then that is the narration. And then, guys, let's take a look at the what? At the transaction number 5. So, guys, we always need to apply our calculations, guys, whereby we follow. If ever you are calculating interest income, then you need to have a rate whereby you're gonna use your rate to calculate. Same as what? Interest expense, interest on loans, what rate, and then for how many months you are expecting to get the interest, or for how many months you are supposed to pay for interest, or how many months you have paid for interest. So all those information you need to keep there. And then, guys, let's take a look at transaction number 5. Transaction number 5 is as follows. An amount of 3,200 was transferred to the account of a local high school as a donation. So now we know that there was an amount that was transferred for what? for donation, and then this amount was debited. So now we know it was debited to the drawings account by mistake, guys. There's an error there. Then we need to correct the error. It was that money, that 3,200 was supposed to go to the donations account, but it was recorded under the debit side of drawings by mistake. So let's correct the error, guys. So we are going to open our account, which is what? Drawings. It's owner's equity expense account, and then it's what? Increase under debit side, decrease under credit side. So what these people did so what these people did, guys, is that they had this kind of mistakes, guys. They happen in our daily lives. And then they had a donation account. They had a what? A donation. They had a donation account. Donation account, it's what? It's an owner's equity, and it's also an expense account. And then it increases under your debit side and decreases under your credit side. So these people, what they did, rather than recording 3,200 under donations, they recorded it under drawings by mistake. So what they did, they took that amount and they recorded 3,200. This is what happened. This was this is the scenario. This is what happened. So now we need to correct the error. How are we going to correct the error? This money is supposed to go to donations. Then we have to cancel this money. How so? Then we are going to say what? A record under what? The credit side. Can I change a pen, please? And then we need to record under the credit side, so that this 3,200 can cancel that 3,200, and then we are left with zero. It's something like 3,200, the positive one, and then the positive one minus 3,200, and then at the end we have zero. So yeah, this is the scenario. And then while remembering that one account credited, meaning another account must be what? Debited. And then we have the correct thing. So normally this was the case. It was supposed to be like this: one account credited, another account must be debited, and then we can take this information and record it in our general channel. And then, guys, we have the account that is first debited will be what? Will be can I change the pen? And then it's what? The account that will be debited first will be donations. With how much? With 3,200. And then account to be what? Credited will be what? Drawings. With how much? 3,200. And then, guys, what was the reason for that? And then the narration for that is that we had an error. It's what? Correction of error. Yeah, it's correction of error, guys. And then let's take a look at our last transaction, guys. And guys, in these mistakes, they normally happen, and we need to understand them, and guys, be able to rectify them. Sometimes this they normally happen, such as maybe we'll get a scenario whereby they say rent income was received, but it was wrongly debited under rent expense. And then, guys, you'll have to correct the error. And then, guys, our last transaction says transaction number 6. Part of the building has been let to J for 4,000 per month. So the part of the business has been what led to give 4,000 per month, meaning we need to what to receive 4,000 every month. Then it's what and then it's what it's rent receivable every month for how much? For 4,000. And then we have our ledger account, which is what? Rent income. It's owner's equity and income account. It increases under credit side, decreases under credit side, meaning we are going to get how much? 4,000. So it's receivable every month. And then we'll have an account that is what? Rent receivable, and then debited, and then credited. Yes, it's an asset. The money is coming in the business. And then one account is credited, meaning another account must be what? Debited. And then guys, in this case we can just record the information. And then general for this transaction, we're gonna have what? The first account debited is what? Rent receivable with how much? 4,000. And then we have rent income of how much? 4,000. And then what is the reason for that? And then reason for that, we'll say that it's what? It's monthly rent. We can say monthly rent. Yes, it's a receivable monthly rent. And then guys, I hope that if ever you don't understand, you will go back and rewind so that you understand. So this was our general journal. And then make sure you have your timeline and you study. So guys, please subscribe, like, and then share. Press that notification button so that whenever I upload, you are notified. So guys, it's a bang.